I think there's been a general recovery in the manufacturing sector. Part of that is certainly front-loading, and I think that's one of the reasons why you see this divergence between manufacturing and services. Manufacturing clearly still doing very well, I think much better than many of the more bearish analysts would have expected. Services, you see that there's clearly a confidence impact, and I would argue that services is what really matters for the ECB, because that's the indicator that's still mostly correlated with the overall GDP. It's also the largest share of the economy, so therefore the ECB will probably be more paying attention more to those weaker services figures.
And given the importance of services, the outsized importance, what could restore confidence, and what is your sort of prediction for how services activity evolves from here?
I think in the short term it's challenging to see what can restore confidence other than these trade conflicts going away completely, which is probably unlikely. In the medium term, what needs to happen is this big German fiscal package that was passed just 2 months ago, it really needs to come online. The Germans really need to sort of step on it and use the monies they have for public sector infrastructure improvement, really use them productively, and I think that is what can drive the service sector of the European economy going forward.
How quickly do you think Germany is actually going to be able to deliver? I mean, and what is your assessment of how much execution risk there is with Germany's spending package? Because it feels like a lot of investors are piling into this trade when it comes to markets here, but what's your take from an economics perspective?
So Germany and the EU, they always have some implementation issues.
Right.
There's planning challenges and so forth. However, this government, I think for the first time in a very long time, in decades, has shown that they're willing to act. So let's hope that this new German government continues to be willing to act and they get the groove on when it comes to fiscal policy.
When is it going to start showing up in the data? And I mean, you talk about today's PMIs and the manufacturing sector probably holding up because we're seeing some front loading, not the case with services. When is that front loading going to stop, and are we going to then see the defense spending sort of take over and offset the negative hit from tariffs that we're likely to see in manufacturing?
So I think on the manufacturing side, there'll probably be a pause for some time.
Okay.
Because the front loading is going to stop. At the same time, because the tariffs on China are so high,
right,
competition with Chinese goods, of European goods on certain markets is going to really intensify. It's going to make it very challenging for European goods producers to stay competitive going forward. And the defense spending is probably going to come online at the earliest in 9 to 12 months' time. So, maybe the next month or so, manufacturing will still be all right. Then it'll probably weaken. And then there'll be a recovery sometime next year.
Can you flesh out a little bit more the impact that you expect to see from Chinese goods flooding the market, and how much of that we're going to see in Europe?
So I think this could be quite a lot, and in the sense that, you could describe the current China-US situation as an embargo. And clearly, I think there's probably already some trade diversion towards Europe. What it basically means is that the prices of Chinese manufacturers' goods are going to fall significantly. It's very unlikely that the European Commission will be able to, in time, raise tariffs on Chinese goods to offset that.
Yeah.
But perhaps the largest impact is on certain markets in Asia, Africa, and Latin America, where Chinese goods will become very, very competitive. And unfortunately, that's not the case for German goods, especially because the euro has been appreciating so much.
What does this all mean for the European Central Bank?
So I think what it means for them is clearly manufacturing still holding up, but services going weaker. That is the major part of the economy. It is also where inflation is sort of coming from there, so they have disinflation. I think they can easily cut to 150, perhaps lower, depending on where this pans out. But then after that, there will be a pause in rates, maybe at 150 for a while. And then in 2026, I think they'll hike again as the fiscal comes online. So it's really a U-shape for interest rates.
So already in 2026, you see them raising again?
Yeah, probably late 2026, because I think the incentives for the German government to really step on the fiscal accelerator, put the pedal to the metal, so to speak, are pretty strong at this stage.